is a tool, wealth is freedom, and financial intelligence, that's your ability to use both wisely. Today, we're diving deep, exploring everything from the basics of money, personal finance, investing, business, accounting, to risk management. This isn't just theory. You'll get real-life lessons, examples, and actionable strategies you can start applying today. By the end of this video, you'll understand how to manage, grow, and protect your wealth, and why most people fail because they ignore the rules of money. So, settle in. Stay with me till the end. And before we go further, make sure to like, share, and subscribe to Love and Life Hub. Your journey to financial freedom begins now. Financial intelligence isn't just numbers, it's mindset. It's understanding how money works, knowing the difference between assets and liabilities, and making smart decisions about how it flows in your life. Assets are things that put money in your pocket, property, investments, businesses. Liabilities are things that take money out, loans, credit card debt, or any obligation. Your net worth is simply the difference between what you own and what you owe, and tracking it gives you a clear picture of where you stand financially. Cash flow is the lifeblood of your finances, the movement of money in and out of your accounts. Positive cash flow means more freedom. Negative cash flow means stress and constraint. That's why budgeting is essential. A budget isn't about restriction, it's about giving your money direction. It tells each dollar where to go instead of wondering where it went. Understanding the difference between income and revenue, active and passive income, saving and investing is crucial. Active income is what you earn through your work, while passive income is what works for you. Rental property, investments, dividends. Saving protects your money, investing grows it. And in a world where inflation constantly erodes purchasing power, making your money work is non-negotiable. Financial literacy is the ability to understand these concepts and apply them consistently. Knowing the difference between gross and net income, tracking your expenses, setting financial goals, and maintaining liquidity ensures you're never caught off guard. And yes, understanding your credit score is just as important. It's your financial reputation in numerical form. Managing money is like managing life. It's about discipline, planning, and foresight. Debt can be a tool or a trap. Good debt, like a mortgage or an education loan, builds future wealth. Bad debt, like consumer loans for depreciating goods, drains your resources. The key is to understand interest. Compound interest in particular is your friend. Money grows faster when interest earns on interest. This is why starting early is so powerful. Credit cards, mortgages, personal loans, and overdrafts are tools. Use them wisely. Your goal should be to control them, not let them control you. Studies show that people who track their spending and manage debt carefully are more likely to accumulate wealth over time. Financial discipline is the foundation of all success. Pay yourself first. Set aside savings and investments before spending on anything else. Even 10% of your income, consistently saved, compounds into financial freedom over time. Diversification is another critical principle. Don't put all your money into one asset or one type of investment. Spread it across stocks, bonds, and real estate. Asset allocation should reflect your risk tolerance, how much risk you can handle without losing sleep at night. Retirement planning is not optional. Accounts like 401ks, Roth IRAs, and traditional IRAs offer tax benefits and long-term growth potential. Don't wait until it's too late. The earlier you start, the more compounding can work in your favor. Insurance is your safety net. Life, health, and property insurance protect you from catastrophic financial events. And remember, giving isn't just generous, it's a key to purpose. Strategic giving can enhance your financial journey and life satisfaction. Investing is where your money begins to work harder than you do. Stocks, bonds, mutual funds, ETFs, each has a role. Stocks give you ownership in a company. Bonds are loans that earn interest. Mutual funds pool money to spread risk, while ETFs trade like stocks, but track indexes. Understand market risks. Systematic risks affect all investments, while unsystematic risks are specific to one company or industry. Diversification reduces unsystematic risk. Dollar cost averaging, investing fixed amounts regularly, helps manage volatility. Dividends provide regular cash flow. Capital gains reward patience. Growth stocks promise appreciation. Value stocks offer stability. REITs allow you to invest in real estate without buying property directly. Leverage, margin accounts, and hedge funds can increase returns, but also amplify losses. Know your investment horizon, stick to your strategy, and remember, compounding over time beats speculation. A real-life example. An individual who invested just $500 per month in a diversified ETF at age 25 could have over $500,000 by 45, assuming a 7% annual return. The secret isn't luck, it's consistency and patience. If you run a business or plan to, understanding finances is vital. Metrics like working capital, ROI, profit margin, and break-even point tell you if your business is sustainable. EBITDA measures operational performance. Cash flow statements show where money is coming and going. Financial forecasting, capital budgeting, and ratio analysis help you plan growth. Debt-to-equity ratios indicate leverage. Retained earnings can fund expansion or new opportunities. Always know your numbers. The most common reason startups fail is financial mismanagement, not lack of ideas. Accounting is the language of money. Double-entry bookkeeping ensures accuracy. Accrual accounting records income and expenses when they occur, while cash accounting tracks actual cash movements. Depreciation and amortization allocate costs over time. Financial ratios measure liquidity, solvency, and profitability. Inventory turnover and accounts receivable efficiency show operational strength. Variance and break-even analysis reveal gaps between plans and reality. Strong accounting practices allow you to make decisions confidently and avoid costly mistakes. Risk is inevitable. The financially intelligent prepare for it. Diversification, hedging, and insurance protect against loss. Systematic risk affects entire markets. Unsystematic risk affects specific investments. Operational, credit, liquidity, economic, and political risks must be evaluated. Interest rate and leverage risks can amplify both gains and losses. Exchange rate risk affects international investments. Contingency planning ensures you can survive shocks and crises. The 2008 financial crisis showed that preparedness separates winners from losers. Financial intelligence is not a one-time achievement. It's a lifestyle. Start today. Save, invest, plan, protect, and keep learning. Knowledge compounds faster than money ever could. If you follow these principles, even small steps lead to massive results over time. Remember, wealth isn't just money, it's freedom, peace, and the ability to live life on your terms. Don't forget to like, share, and subscribe to Love and Life Hub. Hit the bell icon so you never miss our tips for living wisely, loving deeply, and thriving financially.